Welcome to the Private Lenders Podcast with your host from Hard Money Bankers, Jason Balin and Chris Haddon. This podcast is sponsored by HardMoneyMastermind.com.
Welcome back to the Private Lenders Podcast. I'm Jason Balin from Hard Money Bankers, and in studio today from Cincinnati, Ohio, are the guys from Sharper Capital Partners, Grant and Chris. Grant, welcome. Thanks for tuning in with us here for a little bit.
Thanks for having us.
Yeah, Jason, it's great to be on here.
Yeah, absolutely. I'm definitely looking forward to this conversation. You know, you guys kind of remind myself, my business partner, Chris, of ourselves, just because we started at a kind of an early age, just like you guys. You guys are still in your 20s, and you know, it's not just starting early, it's also just being like super ambitious and going all in into this business model. And I think you guys realize the power of this business model, and you know, I'm sure you really are energized when you wake up in the morning and you're like, wow, this is a lot of fun doing this. And you can make, you know, a good amount of money along the way. Like, what led you to hard money? What was the first time that you heard the term hard money or private lending and were like, wow, this is an interesting concept?
Yeah, so I originally started private lending back in 2020 maybe, like at the end of 2020. End of 2021. And really was looking for a way to earn some, you know, passive income on the capital I had. I got some money from a family business exit. So I think that is kind of like an anomaly to my story in comparison to maybe how some of the other people's stories have gone, but was just lending money to someone privately for a couple years. And then I came across your podcast, and that's really what led us to kind of explore the hard money lending business altogether.
And when you were lending money to somebody one-off, like, did you ever flip a house before? Did you know anything about real estate investing? Or is it just like, hey, Grant, I think you have some money and like, I need some money. Can we just, you know, do this deal?
Yeah. So I actually had a couple really good deals come across my plate that I should have bought, and I got cold feet and didn't end up buying them. Like, hindsight 2020, I would have done really well in those deals had I done them, but I was just nervous and didn't really know how to execute. And I was young. I mean, I still am young, but I was younger than I am now. But yeah, so what had happened is, you know, I was like, you know what, I can get pretty confident in lending money to someone that I know is a good operator of these deals. And so really I was like, I trust this person. You know, I have seen them perform well on deals in the past. Plus they're coming referred by someone else that I know is doing a lot of business, which was a local agent who was also kind of in the investment sphere. So it kind of just through word of mouth, we sat down at this guy's office and kind of hashed it all out, like what the terms were. I didn't even necessarily know what I was talking about, even in that meeting. You know, I was like, okay, I know what kind of interest rate I want. How do I want the interest? I want balloon interest. I want monthly payments. I just got balloon interest in the beginning, and I was financing 100% of everything. So it was very risky lending. I didn't know it at the time. But I did have a pretty good understanding of like what asset values were worth. And so I didn't feel too over leveraged. And I did have a construction holdback when I did those loans, even on day one, I had a construction reserve.
Yeah. Like, how did you even know to do that? Like, did you have an attorney that did loan docs?
So not a real estate attorney, but I had an attorney, and he drew up a cognate promissory note, and I would have the title company draw the mortgage up. So I literally did everything the wrong way. I mean, I genuinely did it the wrong way.
At least you had a first lien on the property.
I always had a first lien. Always had a first lien on the property. Title was always clear, you know, always had a lender's policy to my knowledge. And, in terms of like insurance tracking, just like all the stuff that we've learned from you guys, really starting with the podcast, but obviously more advanced as we've gone along. That's really where it started. And then, a couple years in, kind of Chris jumped on board and really just blew the whole business up. So, but yeah.
So how many deals did you do approximately before Chris became involved?
I think I did like 25 deals.
Wow.
It was like, I think it was like a total of like 4 million or something like that. So they were pretty big loans.
That's a lot. And, you know, obviously it made sense to bring in, you know, because you guys were friends previously, and I'm sure you guys trust each other. So it's like, hey, I got this thing, it's going good. Like, maybe we should partner on this.
Yeah, I mean, Chris can probably talk about the story, but I was literally listening to another podcast, a Nick Huber podcast, and he was talking about how him and his partner Dan got started. And one day they're like, "Hey, man, if we just put our heads together, we can do something pretty successful." And I always felt that way about Chris and myself. And I was like, he was in between. He just had left a corporate job to go pursue something on his own. And I was like, "Why don't you come over here?" And at the time, I had just acquired some self-storage facilities. I had acquired about 500, 600 units of self-storage. And so he was supposed to help with the standard operating procedures over there. I was still working a medical device sales job, but I had been really spending a lot of my time processing these loans and getting these loans closed. And kind of realizing that's where I was spending all my time. That's where Chris initially jumped in. Again, really, even at that time, not necessarily planning to make it into like a whole hard money lending company, but just with the focus that, hey, I'm going to take this off Grant's plate. And then, when he gets some more time, we can focus back on the self-storage side or acquiring other assets, but definitely not building a hard money lending company initially.
Chris, what were your thoughts kind of starting out of like, hey, I trust you, Grant. I like you, Grant, but like, is this a real thing? Like, because a lot of people don't believe that hard money companies or private lending companies or even real businesses, because they're all run kind of solely, they're small operations, but they're super lucrative and they're extremely profitable compared to a lot of other businesses. And, I guess people don't see it that way. It's like, oh, well, hey, if you're going to work for a real estate firm, you should work for like a brokerage or, a big real estate development company or somebody. They look at these like mom and pop shops where it's like, one operator with some capital or a few operators. And they're like, yeah, is this real? Is this going to be, around in the future? Like, what were your thoughts on that, Chris?
Yeah, I think it's worth noting that Grant and I knew each other well before he started this operation. So we met in college and developed a great relationship and always knew that we wanted to go into business together. It was just kind of a matter of what opportunity was going to present itself or what direction were we going to pursue. So we both had looked at real estate investing as an avenue of kind of starting a business, and we knew that real estate interested us, right? So we were going to the meetups in college even together, and we knew about private lending, we knew about building a portfolio and kind of what all that entailed. We just hadn't actually done it ourselves yet, but it wasn't a completely foreign space for us. So when Grant started private lending, I mean, he and I talked about the opportunity that first came across, for lack of a better term, his desk, right? He's like, hey, this guy just offered for me to, fund some of his deals, and I don't know if I should do it. And we had this conversation and we were like, who knows where this will lead? And I think you should give it a shot. And so ultimately when he started doing that, I kind of knew, because of our relationship, the revenue and profit that he was generating from that endeavor. And so plus I also knew about private lending and about, the power of using private money as a real estate investor and how everybody endeavored to become the private lender, because you could make money without having to actually swing a hammer or hire contractors or whatever it might be. So I was a little bit familiar with the setup, and also Grant and I had a good enough relationship that was very transparent. Plus, when I left my job and he and I started together, I needed to have some sort of salary, and he was paying me from the private lending proceeds. So I was like, all right, well, there's actually some money here. Whether or not it was going to turn into something like we have today, obviously I had absolutely no idea, but I was confident when we went into it.
Kind of similar story to Chris and myself. Because we went to high school together, and we always knew we were going to start, we were friends in high school. We weren't like best friends in high school. And then like after college, we both went to separate colleges, came back into the area. We started hanging out. We're like, wow, we both have like an entrepreneurial mindset. We're both kind of salesy. We want to grow something. And we're like, hey, let's start flipping houses together. And then I was like, yeah, this sucks. Like, that's a lot of hard work. And then we're like, hey, we're both in the mortgage industry. Let's start our own mortgage company. And literally, like, we got as far as setting up an entity. And then like early 2007, maybe late 2000. Yeah, early 2007 is when like a lot of like mortgage businesses went out of business and stuff like that. And we're like, yeah, maybe we don't want to be a mortgage company, but like we still love the finance side. Maybe we should do hard money. And like, and he was working at the time. I had quit my job because I was like, if we're going to do this, let's just freaking do it. Right. It's easier when, not that you can't get into this industry at any age. Like you certainly can, but like, we were still in our 20s, no kids, weren't married. We didn't really have any money to start with, but we still were able to kind of get things moving forward. And, it is one of those things that, not that you can't do part-time, but I think it is easier when you're solely focused on these things. I think one of the things that a lot of people in the mastermind group that we've all talked to, and this might be yourselves as well, where it's like, man, I just don't want to talk to any more leads, or I don't want to process any more loans. And it's just like, that's just because you have to if you don't have staff at the beginning, and it's a pain in the ass. And like year one, I think we closed 14 deals or whatever. And like, I was in the weeds. Like, I was so busy. I was like, how could we ever do more deals than this? Like, this is impossible. Right. And then like, year two, you do, twice as many deals as that. And like, that's the natural trajectory. And I think you guys are still probably on a forward press, move up trajectory. And it's like, you just kind of get used to it. And I remember David Little in the mastermind group, he said, hey, my processor, she's really overwhelmed. And I was like, well, how many loans is she doing? And I think he said like 5 or 6 a month. And I was like, dude, like you can get her to like 30 or maybe, well, and even if you back that out to like 20, but he's like, dude, I don't know how to do it. And I was like, you kind of just get used to it. And like, Chris, I know you're really involved kind of on that as well. And I know sometimes it's overwhelming, but like after you do it and you're kind of used to it, and a lot of it's rinse and repeat, like I'm sure you can attest that it does get a little bit easier.
For sure, especially if, let's just say for sake of example, you're processing 10 loans, 5 of them are repeat clients and 5 of them are new. Those repeat clients, you might not even have to talk on the phone at all about a deal. They might even be able to just send you an email with the scope of work and contract, and you guys know, you both know how it goes, and you get to a closing table. It's super easy. So
how is your guys like day-to-day divided? Like who does what?
That's something that we've actually been looking at getting better at. So, I mean, like in like full disclosure, like there was a period in the month of the whole month of February, I don't think we originated a single loan. And we were kind of like, man, like, are we in the right business? Like, what are we doing wrong? And we had, been consistent in our marketing. And so that month really wasn't indicative of like all the work that we had put into the business. But before that, like, it was really, I'm doing all the back end stuff, like, working in TMO, doing the accounting, doing the capital raising, capital placement. And then Chris is doing all the origination and doing all the processing, helping out with some of the construction draws. I was doing a lot of the construction draws too. And in that month of February, it was like, we had more capital coming in from loan payoffs, trying to figure out something to do with them. So Chris was out actually looking for us to buy real estate. And then March came around and we had a record month. And then April came around and we had another record month. And then May came around and we had a bigger month than that. And, so it's been now we're like, okay, we don't really want to own real estate right now. We're kind of like back out of that. And I think that's a lot of shiny red object syndrome, like in the beginning where, you're kind of trying to figure out where the next deal is going to come from, but it doesn't seem to be coming. But right now, I'm still originating a couple loans and processing a couple loans, while doing the back end stuff, like I mentioned earlier. And Chris has still been like the heavy horse in terms of pulling the cart on originations, processing, and really a lot of the marketing too. So that's kind of how it's been divided.
Are you doing the servicing inside TMO yourself?
Yeah, we do our own loan servicing.
Like, is that part of your day to day, or you have someone else that does some of that stuff?
No, I do all the loan servicing myself. Yeah.
And payoffs. And then, so it's a similar situation to myself and Chris, where like I'm doing everything kind of on the front end origination stuff, and then he's doing everything kind of on the back end, type of thing. And that's and that's, at a decent sized portfolio, it's challenging without staff to help some of those things. And, typically I look at it as like, there's two key hires, someone on the back end, which is, called a controller or a staff accountant that's just like doing everything inside loan servicing, and then someone on the front end who's doing processing. And, you guys both know how to do all the keystrokes, but it's definitely a good thing when someone else is doing those keystrokes and you're kind of just making sure they're all right. Like, it makes it a little bit easier. And, it certainly takes time to do it. And I'm sure after you have a February month with like no closings, you're like, oh crap. Like, I'm scared to potentially bring somebody in. And I think a lot of people had crappy January and Februarys, including ourselves. And I don't know. And this business kind of comes like that. I remember like was a few years ago, maybe 5 years ago, and we were obviously still a very matured company at that time, that like 1 month, I think it was like October, we had like 3 closed loans and we were freaking out. We're like, what is going on? And we had like 30 something loans in November, which is way too overwhelming. So like whenever we've done like trailing, months to look at statistics, we usually do by quarter, 6 months, even years sometimes, just to see what's up, because it's, things go like, when it rains, it pours, right? Like sometimes all contracts hit at once. Sometimes like every deal just blows up in your face and you want to like jump off a bridge because it's depressing because you've been working so hard on stuff. So like you've kind of already witnessed this. Well, I'm glad you didn't, jump ship out of the business and be like, yeah, this business doesn't work. So I'll tell you internally kind of like what we've seen over the last month, and I'm curious if, you guys, if it's similar to yours or not. And I have realized that every market and region inside United States is just different. Like people, we all do, similar types of deals, but they're masked a little bit differently. And in general, we've had less lead flow, but our closing rates have been significantly higher, which is, good and bad. Like ideally that's what you want, right? You want like, hey, in a perfect world, hey, send me, 3 deals today and I'll pick the best one and I'll close it, right? Like that's in a perfect world, instead of having to go through 30 or 40 or 50 or 60. But at the same time, it's also a little scary when you're used to getting tons and tons and tons of leads, but, you're not getting that many, but at the same time, you're getting a few and then they close. Have you guys seen that recently, or is it just kind of been status quo?
Yeah, we've seen the exact same thing. So I wouldn't say our lead flow has gone down, but to your point, our proportion of closed leads and quality of leads has gone up. So our lead flow has more or less stayed the same over the course of this last year, 2 years. But our portfolio has been consistently growing. And that's because, to your point, Jason, our proportion of leads and our quality of leads have gone up.
Yeah. So, yeah. And that's, obviously a good thing. I mean, I'm a real firm believer that this type of business will be around forever. Now, there's definitely going to be different seasons and there might be different types of deals that we've done. Like, I'll give you an example. Like, years ago, every deal we did was like high credit score, fix and flipper, professional flipper that did tons and tons and tons and tons of deals, right? Like that was just everything. These days, yeah, I still get those, but that's not the entire portfolio. We have a lot of like what I call probably like B paper, and to me, like what that is, and I love B paper because to me it's like contractor types that have like low 600 credit scores but have a lot of cash and a lot of experience. And I was talking to Logan, who we both know, recently, and he was like, man, Chiavi's killing me on some of these deals. And I'm like, yeah, but like they can't be your competition. Like they're going to give high leverage, cheaper terms. Like they're only working with, very quality borrowers on stuff. And I was like, we do a ton of stuff for these B borrowers. I think they're A deals, but they're just B borrowers, right? Like they got low 600, 620 credit score, but they'll put down, instead of, 20 or 30%, they'll put down 40% on some of these deals. And they have tons of, experience building houses, renovating houses, and they don't shop around because they don't have many other options because they can't go the institutional route. Have you guys dabbled with that types of stuff?
Not so much. We definitely have some of those on our portfolio or in our portfolio right now, but I'd say, and Grant, I'd be curious to hear what your opinion on this is, but it's more so the A plus kind of like A paper that you were talking about, Jason, where it's people who are running their shop like a business. Yep. And they're super high quality borrowers with good credit and they have rental portfolios, but they also flip. Yep. And a lot of them are direct to seller. They have their own kind of direct to seller marketing channels and wholesale on the side. So I'd say it's more so the former. Between A paper and B paper. It's A. Yeah.
Yeah. I mean, we try to do like, we've tried to be open, and that's when we started. Like that's all we did forever. Like we didn't even do any commercial loans because I didn't even know how to structure commercial loans early on, and that's a big part of our business currently as well. So like I think it's kind of important at some point, to diversify into different types of asset classes, different types of everything's still under the same umbrella. The terms are the same types of deals. And it's I'll give you an example. I don't know if I've told you this story before, but between like 2008 or 9 and 2012 or 13 or 14, we did over 100 loans for one real estate investor. He's one of the biggest flippers in the country, and he was local to us in Northern Virginia. Performed great. No one had an issue. The capital investors would be like, yo, can you put me in another one of these deals? Blah, 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 blah. And it got to a point where like he wanted too higher leverage. He wanted cheaper terms. It just didn't work. It did. Like I was too scared to give him loan. You know, I think we've all thought the market was going to has decrease in value over a long period of time. It just never has. It continues to increase, but at some point it could. And I was too scared on a conservative level that the day that deal comes, that he's broke or he goes out of business, if that ever comes that day. And I was also like, we're not making enough money on his deals. Like, I don't like where it doesn't work. So like for us, he outgrew our business model. And I think that does happen with folks where you do whatever, 10 deals for them. And then all of a sudden it's like, hey, can you lend me some cheaper money? And as a business decision, you can determine if you want to lend out cheaper, or if you want to say, hey, I don't want to do 80 LTV. I want to do a 90 LTV because I know this guy's performed 100% of the time. And he probably will. And let's be honest, like he might forever, but we kind of has always taken the stance of, hey, if they outgrow us, they outgrow us. Let's go find somebody else that we can kind of nurture or kind of structure some other deals. And like a side note on that I'll never forget that this guy said to me is he was like, well, that's stupid, Jason, because why wouldn't you give me money a little bit less cost and higher leverage than some newbie that doesn't know what the hell he's doing that probably is going to default on the construction budget? And he's not necessarily wrong. Like that's a good statement to say as an outsider. And I was like, yeah, you're right. But I'm not just making more money on that particular client. I'm also way deleveraged on that client. So yeah, you were getting higher leverage, but like this guy, especially at the beginning, is bringing significantly more money to the table on these deals. And I don't know. So that's just been our setup. You know how it's performed, and like the performance is still the same. Like they still make good monthly payments. So have you guys dabbled in any construction or commercial stuff yet?
Yeah, we've done smaller commercial. We have not done a ton of them. We've done commercial residential, and we've also done commercial, I guess more or less retail. It's kind of an interesting one. But yeah, we've done a couple of those, and we would love to do more of them, similar to your statement earlier. We'd love to do more commercial stuff and have, maybe more sophisticated borrowers and higher down payments, and maybe not so much construction on that side, but maybe it's just a true bridge loan, getting them from maybe previous financing to their new type of financing, whatever it might be. But we've done a couple.
Yeah, we've found that the hardest part about finding the commercial stuff is that it's almost they have to find you and you not find them on stuff, because like they would come through our normal online Google ads or Facebook ad channels. It's hard to do like direct marketing from them, but a lot of them are attached to a broker. So if you can attract the broker, they can attract it to you. And I mean, we only lend 40, 50 LTV on commercial stuff. But that being said, the quality of borrower is good. The big issue that we've seen with commercial stuff, and I don't know if the deals you've done have even paid off yet, but I will tell you that the exit strategies are just challenging. And you take that into consideration. That's why you lend 40, 50 LTV to a good quality borrower and let them be proactive to try to get out of your high interest rate note to try to get cheaper terms. And that's the motivation to them. And if they can't, if the building still services the debt, you're at a 13% or whatever you're charging interest rate, so be it. It stays on your books for a longer period of time. So
yeah,
we've had
they both paid off.
And
not to interrupt, but both of the ones that we've done have paid off. And one of those two commercial deals, as Grant can attest, it's by far one of my favorite deals that we've ever done. And it was super unique and super low leverage, really high quality borrower, and one of my favorites for sure.
How'd he pay it off? Refinance or sale?
Yeah, they refied it. We recommended a broker that's local to Cincy and does a lot of the commercial stuff around here for multifamily, and also for some of the more like business, retail, kind of industrial commercial space. And honestly, I was a little bit concerned that they weren't going to be able to refinance it. I had no idea. This one was interesting because it literally had an in-ground pool in the building, and it also had a retail space, and it was an owner occupied commercial space, meaning like they operated their business out of this building. So I felt really good about that. They put a bunch of their own cash into renovate it and fix it up, but I had no idea what kind of takeout financing they were going to be able to get or not get. And they ended up getting out of it. And I don't think they really even had any issues. So it was a pleasant surprise, honestly, when they paid it off.
And that's challenging because it's just different. Like we all know what like, you know, a DSCR loan looks like and who will qualify for them. Like a commercial deal is a lot of its banking relationships, you know, with them. Like, you know, we've been out, like we did some loans for borrower that only had like a 600 credit score, but you know, we were at, you know, we lent him maybe 200 on like these $1 million retail centers that he had. And I was like, this guy's not exiting these things. And sure enough, even with that credit score, he still got out of them clean because he had long-term banking relationships with these credit unions and some other local banks. So like, sometimes you never know, you know, on another end, I don't know if I told you this story when I saw you last in Texas, but we did this loan. A guy had a 10-year loan with Bank of America. He put a lot of money down into it. It appreciated a lot in value. He ran his medical urgent cares out of there, and the loan came due 10 years later. He still had good credit. He still had good financials. He still had other properties that he could cross collateralize. And they're like, nope, loan's due. And he's like, cool, we'll just extend it. And they're like, no, it's in foreclosure. Like, pay us off. And he scrambled. And this is a few months ago. And, you know, we did a loan. He brought cash to the table to do the loan with us because, like, I don't know, kind of wanted him to have some more vested interest in it. So he bought down the loan a little bit. We gave him a loan, and I would guess he could refinance. It seems like someone like that could, very high 700s, but like, you never know. Like, they're fickle the way banks are set up. And it's just, those commercial deals are just more, you know, the biggest variable is like, you almost need a bank loan on those because they're not selling those typically. Not that they don't, but like, they're not flipping houses. You're flipping a house, you know? So the exit strategies are typically like, they have to be bankable. And that is like, and I'm guessing that's probably one of your requirements as well. But our requirement is like, they do have to be a good financial borrower and they have to have good credit. Like, we can't really lend a crappy commercial borrower, you know, that falls into like a loan to own game, which is not a great business model for hard money lenders. What's kind of the future look like? Like, what's end of year, end of 2024, kind of end of 2025 into like the next 5 years or so? You guys thought about that?
Yeah. I mean, I think Chris and I were just talking about it before we got in here. We're just under 10 million. We'll probably cross 10 million this month in terms of outstanding loan portfolio. We have like 5 million of our own capital and 5 million of OPM. So like, you know, we're just kind of like 50-50 in terms of like what we have on the street in terms of our capital versus outside capital. And so we think that, you know, I'm personally like nervous about getting like too over leveraged with OPM. So like, you know, without having enough like equity in my portfolio, like I'd rather just lend less and, you know, try to increase rates and make more money.
Amen.
And so, you know, we'd be comfortable going like, you know, I guess it'd technically be 2-to-1 to go to like 15 million or 10 million in OPM and 5 million of our own money in the deals right now. And kind of just sitting it there until we build a larger equity position to, you know, kind of maintain some balance, because like you said, like you never know what's going to happen with, you know, the assets that you're lending on in terms of just, you know, where the market's headed. And we definitely do want to get some more key hires into our business as well to take a little bit more of the workload off of us. I mean, even at 10 million right now, like it's, you know, it's work to get around to everything and, you know, just keep your books up to date and all that fun stuff. So I think the long-term goal or the midterm goal, call it, is, you know, close to 15 million on the street, you know, 10 million of that being some sort of outside capital, 5 million of it being our own, and just trying to maximize that as we increase our equity position, our own portfolio, and then potentially scale it from there.
It is the plan to try to, you know, push as much of your own personal capital back into these deals to be the capital investor, to be the lender?
Yeah, I mean, I think that's definitely like a great use case for it. For us, like with the rates where we're at, like it makes sense to employ leverage to get a decent, you know, return on equity for the amount of cash that we have in the business. So, you know, like maintaining like that, like 50-50 leverage is kind of like, you know, what we're comfortable with, what I think is like ideal, because that keeps us somewhere between like a 20% and 30% return on assets, return on equity, whatever you want to call it, or return on equity.
And when you say leverage, is that bank leverage?
No, I mean, not necessarily. Like mostly just outside capital in general. It could be bank. It could be, our capital investors, but some sort of outside leverage that isn't our own money, outside capital that isn't our own money.
Got it. Yeah. I mean, and that's the beauty of this business is, it can spit out high rates of dividends so you can pay capital investors good returns if you need to. And I don't know if you've got calculated this internally or not, but like, I'm guessing, you're probably making at least 20% off your own personal capital, unleveraged on these deals, assuming money's turning, every, twice a year.
Yeah.
I'm guessing it's probably going to be similar to that. And, and that might not even be including late fees, extension fees, as your portfolio grows, as portfolios grow, like extension fees are a really big part of our business. Late fees are a really big part of of our business. You end up, it ends up being kind of, I don't know, like a few months ago, I think it might have been in the month of February, one of our offices didn't have any closed loans either. And the owners of the entity, which obviously I'm one of the owners as well, we still took the same amount of money out as we would normally do, like we used to, just because, there's servicing income that comes in. There's still late fees. There's extension fees. There's a few big extension deals that defaults that paid off. So like, that's the beauty of, having a good profitable portfolio that's structured correctly is, there's a lot of different income streams that come in. It's not just it's not just on the front end.
Yeah. We recently redid our P&L to kind of break out, not just like not even just like, okay, this is the origination income and this is the interest income and servicing income. Like we've broken it out to like all the additional fees that we have inside of our loans. And it really does paint a picture to go like, holy cow, like there's a ton of fees there's a ton of revenue that comes in from other fees that, we've just added in intermittently, whether it's construction draw fees or processing fee or anything like that.
That's right.
We've recently added in. So it does make a difference to your point.
No, that's right. And I remember when we started out, like year one in the business, we thought we were just kind of like brokering loans to investors. Like we were still going to control it, but like, hey, we'll just take the points and you just take the whole interest rate return. And boy, were we wrong about that. That servicing size portfolio and the additional fees and stuff really turn that into a well-oiled machine. So, as of now, you're focused on, obviously you're in Cincinnati and obviously I'm sure that's your main focus, but you'll do pretty much all of Ohio and Northern Kentucky.
Yeah. Yeah. We have loans in like all the major metros in Ohio, whether it's Cincinnati, Columbus, and even Cleveland right now. Try to stick to the areas that we know best, which are, Cincinnati and parts of Columbus, and Northern Kentucky. But those are the markets that we focus on.
Do you see that market share as like, hey, we're going to be in this, no one knows what's ever going to happen in the future, obviously, but like, do you see that to be the core area forever? Or do you see yourself as like, what, like we might want to expand, or we might want to, really just stay focused in Cincinnati? Like, how do you see that kind of playing out?
Yeah. I mean, with the portfolio size that we're shooting for between those areas, like if we're trying to get 15 million on the street, I think we could do it between Northern Kentucky, Cincinnati, and, Columbus and dabbling in Cleveland on a case-by-case basis. So I don't see the need necessarily to go and play in other markets, especially when, we have such great resources locally here. And it definitely mitigates our risk. Like you kind of hit on essentially what we stand for earlier, which is we want the best risk-adjusted return possible. So that means lending on the collateral that we understand really well at good LTVs to great borrowers. And so for that reason, like we definitely could, like there's plenty of other local markets, whether it's Louisville is the same drive time as it is to go into Columbus from Cincinnati. So it's, it doesn't make a big difference to go that way or to go to Indianapolis. It's about the same drive time too, from Cincinnati to Indianapolis as it is from Cincinnati to Columbus. But, it's just another layer of complexity, like a new, new legal system that we need to, get familiar with and build the right resources in that market, whether it's, third-party valuations, learning that market, all that stuff. So we just try to be really particular about the deals we do.
Yeah, and you should. And there's no reason. I mean, the folks that really fail in this business are the ones that try to scale too quick, or they just kind of don't have, they don't have their ducks in a row and they're not doing it the right way. They're just giving too high a leverage. I mean, listen, you do a few bad deals, like you're out of business. You lose 7 figures pretty darn quickly if you just by doing a few crappy deals. And like, that doesn't mean like really crappy deals. That just means like, hey, I gave them too high a leverage. Like you're not Wells Fargo. You can't absorb losses like that. And there's no need to.
Yeah. I feel like so much of the loan origination process for Chris and myself is, helping people come to terms with what the actual after repair value is on these properties. Obviously the more experienced investors, like, that they have a pretty good sense of where the market's at. But even then, like, sometimes they get a little ambitious and you're like, that's just not where we're going to lend at. I think if anyone's great at that, it's Chris. And so he's had more reps on the loan origination side than I've had. So he understands the property values even better than I do and has the conversations probably 10 times better than I do. But that's just been so key to our success. And, we have some loans that are what I would call wobbling, where like, some of the really it's just one borrower, but like we have, a borrower that, it's kind of up to question as to how it's going to play out. But either way, our position's fine because of where we lent at. And, I don't lose sleep over it for a second. And I don't think Chris does either.
Dude, exactly. People, I'll tell like part of the scripting that I'll talk to some of these real estate investors up front. And they're like, oh man, I got to bring that much money to the table. And it's like, listen, you might need a little bit more cash up front, but like, I don't want to babysit you. You don't need anyone to babysit you. Like if you want to go and find a lender that gives you higher leverage, they're going to micromanage your construction project. They're going to micromanage everything for you. It's going to be hard to get draws. It's going to take time. And like, you're a professional and I'm going to respect you as a professional. Like put down a little bit more cash and it'll be a very, very clean, easy process. And people like appreciate that and respect that, especially if they're coming from institutional back capital. So I think it makes sense. And like, as you grow in this business, like you don't want headaches. I know lenders locally that would just do loan to owns where they'd be like, hey, I'll just lend 50% of the purchase price on everything. And like, that is just a recipe for disaster. Like on the collateral, could it make sense? Yeah. But then you're dealing with like lower quality borrowers that aren't sophisticated, that don't understand it. You got lawsuits coming up and you're just playing defense all day long. And you're also not turning into repeat borrowers. The goal of this, the way that this business grows, and I'm sure you guys can attest to this, is like every other borrower turns into a repeat borrower, right? So, every 2 deals that we do, ends up turning into a third deal, at least because of repeat borrower. And like, that's how you grow. If we're all just doing one-off deals, it's hard to do the first deal with a real estate investor. There's a lot of stuff that, time and energy that goes into underwriting them, underwriting everything, seeing how they work. But if it's a repeat borrower, I mean, Chris, like I'm sure they text you, email you and say, hey, Chris, I got another deal. How much can you lend? Cool. No problem. Let's proceed. And like, that's it. It's easy. And I think a lot of people are kind of missing the boat on that. All right, cool. Well, we'll get this thing wrapped up. One more question. If you started over from scratch and like knew what you knew today, like what would be like, I don't know, the first few months that you would be focused on? Like what would you guys, like a few tips that you would kind of, recommend for somebody that was, maybe they have some of their own capital. They certainly have access to capital, but they're just like, hey, I'm not 100% what direction to go in. Like, where would you tell them to focus on?
Yeah, I mean, Chris could probably. I'll go first, I guess. But I would build a great team, and I would get in front of as many borrowers as you could. I mean, those are the 2 things I would do. We have a great attorney that we work with locally. We've worked with Merlin and Danehoff, Harris Danehoff as well, and he basically drafted our first, all of our security instruments essentially, so like our loan package and everything. So he originally created that for us. So a little shout out to him. But everything from insurance to, agents that can help you with valuations, contractors that can help you understanding construction draws, all that stuff. But
sure,
getting the right team and then getting in front of as many borrowers as you can. But yeah, Chris, why don't you go ahead?
Yeah, I don't know if it's anything different than what we did, to be honest with you, Jason. I'm not saying that we started off perfectly and did everything the right way, because we definitely made a handful of mistakes, but we certainly would not have the business that we have today without having the guidance from the Mastermind Group. And I just think that we basically skipped, countless number of reps and years to get to where we were when we hit the ground running. Our first deal that we did was as a real entity, a true business, after Grant and I sat down, created the business plan, decided what we wanted to do, was a cross-collateralized loan, which we would have never known how to do had we not been a part of the Mastermind and we asked you guys questions about it. And so I think it's been extremely valuable. And that is, I think, probably the biggest reason for the success that we've had relatively quickly, is just having the relationships and having people to be able to bounce ideas off of and basically leverage other people's experience.
Yeah, I mean, you guys are both super ambitious and smart, and like you're doing all the right things. Like what Grant kind of said earlier about finding deals and what Chris does on a regular basis. Like Chris, I was you, where I would talk to everybody, and like it's a pain in the ass, right? It's not that easy to do, but like I'd learned so much, and there's all these hard money lenders, private lenders that I'll talk to, like, oh yeah, I just want to hire like a sales guy to like find me deals. And I'm like, I hate to say it, but it's a high level task to do the originations and fielding calls. Like you don't know what you don't know. Like you learn so much about it. Like you figure out, like you've got to be on the front lines to know what type of questions people are asking, what type of terms that they're looking for. Like you learn so much. So whenever we've opened up other offices, like non-negotiable, your job is to get the phone to ring and answer every one of those darn calls, no matter what. And we've tried it. We've had in-house brokers, in-house loan officers, assistants, and like front desk people that did like call scripting where they would answer call. We never had success except somebody who's either a partner or has a vested interest in the deal take those calls, and you learn from it. And let's be honest, let's say you had somebody else that did that on the team, and that's not saying that it's impossible for them to do that, but like it would get watered down a little bit, right? Like you have that gut feel of that borrower. Even if you never meet that borrower in person, if that borrower is going to perform or not, just based on the conversation that you have with them. And they know from you that, hey, I'm getting money lent to me by a professional, and I'm going to go with them because they know what they're doing. And they're not just this sales rep trying to sell me and then potentially change terms on me at the end. Like you have a vested interest, and that goes a long way.
The truth of the matter is I couldn't agree more. When we first sat down, we created our business plan, Jason, we started marketing in probably September of 2022. We didn't write a single loan until December of 2022. So that was 3 full months and probably 30 leads per month. So almost 100 phone calls of just leads that I entered into the system, not to mention the countless number of conversations that I had in person and over the phone with other people, telling people, hey, I'm a hard money lender. This is what we offer, without actually knowing exactly what it looked like with our new business model to actually get to the closing table. And without that sense of talking to the borrower, and without actually hearing and fielding the questions that they had for us and understanding what they were getting from other lenders and seeing other, term sheets that they would send us and say, hey, can you match this? We just would have never had a true understanding of exactly what we needed to offer and the conversations that we needed to have in order to close a loan, had we not gone through that. And it's only evolved since then, right? We were driving all the way up to Columbus to go to the in-person meetups in Columbus. We were going to probably 5 or 6 in-person meetups in Cincinnati and hopping on virtual calls, et cetera, cold calling and being all over Facebook. So, it has been a relatively quick transition from 0 loans with our new business model to where we are today. But it's not to say that there hasn't been a ton of grunt work that has gone into that. And, we still are doing some of that grunt work and trying to figure out the best way to generate those leads and have those conversations. But it certainly would have been hard to outsource that piece of the business, especially in the beginning and even now.
It's the best way to learn and jump in and, full feet and do it the right way. This has been great. I certainly appreciate the last 45 minutes that you've spent with us. What's the best way that, anybody that's either listening to this on iTunes or any podcast platform, or if they're watching this on YouTube, to potentially, if they want to reach out to you guys, what's the best contact info or best way to, get in touch with you?
Probably you can reach out. We have a contact form on our website, sharpercapital.com. We're also on like all the, social media platforms and things like that. Sharper Capital Partners is the handle. So you can check us out there pretty much any place where you consume your social media content.
Well, one last question. Where did Sharper Capital Partners name come from? I forgot to ask you that earlier.
So I'm definitely like a nerd, I'm like a academic nerd for sure. I spent a lot of time in the library, and my favorite academic was William F. Sharp, and he was the inventor of the Sharpe ratio, which is the first ratio in financial, like modern portfolio theory, was the first ratio that ever assessed return with risk, which I thought was laughable because, if someone told you get 100% return, but they didn't tell you what the risk was, you may or may not do that deal. And so naturally in our business, we seek the highest risk adjusted returns. Therefore, like Sharper is a tribute to William F. Sharp's last name. And so our company is all about seeking, the highest risk adjusted return possible.
Perfect. Wouldn't have ever guessed that. So I'm glad I asked. Hi, guys. I certainly appreciate it. And we'll chat soon. Thanks.
Sounds good.
We hope you enjoyed this episode of the Private Lenders Podcast. Please note that the opinions stated by all the speakers on this show are only opinions and not intended for legal, financial, or accounting advice. Please make sure to always check with your own legal, accounting, and financial professionals. If you enjoyed this episode of the Private Lenders Podcast, we'd appreciate it if you would spread the word. Make sure to check out hardmoneymastermind.com, the #1 free community for new and experienced private and hard money lenders.